You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. And today I want to talk to you about how everyone is predicting a stock market crash right now and what you should really do to prepare yourself in order to, survive the storm. So basically the analogy I like to use for all the stock analysis and everyone on YouTube and Facebook predicting a stock market crash is that if you just blindly throw 1,000 darts at a dartboard, eventually you're probably going to hit the bullseye. So a lot of people tend to just throw out these random calls and ideas stating that the stock market crash is coming, and they're essentially hoping that a sell-off will occur as a result of what they're saying, so that the buy-in price for them is going to be lower. Now, anytime you see a dip in the market, the best thing to do is to actually not overthink it, not get fear in your head and act out of fear, uncertainty, and doubt. You want to be calm, collected, and continue to follow your strategy. If there's a dip in the market, don't sell, buy more, because you're buying stocks and ETFs and potentially crypto and property that you want to own long term. If every time someone comes up to you and goes, hey man, your house looks about 20% less than it was worth yesterday, you can't just sell it like that. Now, if you take that same psychology you have with property to your more liquid assets, so your stocks, your crypto, you're probably going to do a lot better, because you're not going to have this loom and doom of, oh my God, my assets are going down in price and I need to liquidate them ASAP. So if you stick to your dollar cost averaging strategy and you just keep buying on regular intervals with the minimum amount every month or every quarter or year, whatever that interval is, you're going to sort of balance out the volatility of the stock market. When the cost in every asset comes down in price, you're going to be able to purchase more with the same dollar value. Now, when you are investing, it definitely helps to keep some cash aside, so that if we see a significant drop, you can buy more assets with the same amount of money. So let's say, for example, right, you kept 10 grand in cash on the side, but every month you're putting $1,000 in the stock market. So you're doing a minimum of 12 grand a year. If you saw like a 30% dip in the market, would you not spend that money, or would you actually buy more assets at a discount? I know what I would choose, and I would like to encourage you to choose the same. You could offload some of that cash balance you have, chuck $5,000, $6,000, $7,000 into the market at a huge discount, and then build up your cash portfolio again over time. But in the meantime, you're getting faster gains or a better return on the assets which you've bought at a lower cost basis. Plus, that's averaging your total assets down in price, meaning your overall performance is going to look a lot better. So psychologically, this makes a lot of sense. If, however, every time somebody saw a dip in the market, you sold and then you buy it as soon as you see it go up, you're likely going to end up losing money, because not only are you paying for brokerage, the gains you'll see in the market are generally a net higher rate than the losses, okay? And that's why over the long time, we're going to see the stock market steadily increase in value. So let's say there's a red day, it goes down 1%, and you sell your assets, and then you buy in when it goes up 2% the next day, you're actually going to lose money in the long term. So holding your assets long term is going to be the better performer in this instance. Now, there's a really cool quote from the book Unshakeable by Tony Robbins, and this is saying that if you were to not have your money invested in the 10 best trading days in the stock market over a 20-year period, so if you just miss 10 days of not having your money invested, you cut your returns in half. Now, the more days that you don't catch, so of the top performing days in the total stock market, the more of those are incredible days that you miss out on by having sold your assets and waiting to buy back in, the more exponentially worse your returns become. And I think it was after about 50 of the top trading days, you end up in the negative if you miss those top 50 days over a 10-year period. So it's definitely worth keeping your money invested long term. If you capture all those days of higher gains, your asset value increases, you're going to then have more capital invested, which is going to compound for longer. When you look at the dip in the market as an opportunity, this is psychologically very powerful, because instead of fearing that you're losing money, you're more excited that you've got the potential to make money. And if, for example, you had your dividend reinvestment plan set up, what's going to happen is when that stock price comes down for a moment, your dividends are going to be able to buy in at a cheaper price. So you'll end up with more units from the same distribution you would have got, okay? So if, let's use a really simple example. If I had $1,001 units and I had a 4% dividend yield for the year, I'm going to earn $40 in dividends, okay? So if those $1 units that I have 1,000 of, my $40 dividend would buy another 40 shares, okay? Now, if that value went down to 50 cents per unit, yes, I would only have had $500 worth of the share, but I still have my 1,000 units. That $40 dividend can now buy twice as many shares, getting me 80 units, okay? So a dip in the market when you have your dividend reinvestment plan set up is actually quite beneficial. It's a bit of an opportunity, and it also allows you to buy in more. So I highly recommend keeping some cash on the side for these times of volatility. Try and stay away from social media that's going to try and influence you to act in one way or another, because often these stock analysts and people who predict the doom and gloom in the stock market crashes, they'll be right eventually. But if you look at like the weekly calls they're making, often they are not that accurate. And it's only once somebody, finally hits that bullseye on the dartboard that everyone's like, oh, they called it, but they could be trying to call it for 5 years before that. So who really knows who you should be listening to? I think the best strategy to have is the one that, Warren Buffett recommends, Ray Dalio recommends, and that's just buy the S&P 500 if you're in the United States, or get some exposure to your home market. Buy the index fund on regular intervals, hold it long term, and you will pretty much, over the long term, always win. Now, there's a lot of power in also having this sort of psychology, because you're never going to really have to worry about selling your stocks. Obviously, if you want to cement some gains in, or you decide you need to pull profits to place in another opportunity, that's absolutely fine. But that's a completely different circumstance, because that's a calculated sale, and you're usually taking those funds to tend to other needs. This strategy is far more secure and far more sensible than just selling because the stock market goes down. And I tell you what, if my portfolio were to drop 10%, whilst that would hurt at the time, seeing the value of your portfolio go down, I then know that the next buy I'm going to make is generally at a 10% discount. So that's a really nice psychological win. And especially when everyone's saying stocks are overvalued, why would you keep buying during the time that they're really expensive, theoretically, but then stop buying when they're on discount? That just doesn't make sense. That's like going into, Coles and seeing that bananas are $4 a kilo, but then offering to pay $8 a kilo or $5 or something. That doesn't make sense to me. So, stick to your dollar cost averaging strategy most of the time, okay? When you see a significant dip in the market, perhaps invest a bit more money for that time period. So, if you're typically going to do $1,000 a month like what I do, but you've got an extra $500 to throw in, do it. So you're buying $1,500 worth of units at the discounted price. Or you could potentially deploy a lot more cash than what you had, some of your emergency fund or something like that, if you're comfortable to do so. I'm not recommending you do this, but only if you psychologically can handle it. You might deploy a lot more funds for that month, $5,000, $6,000, $7,000. But then the following months after that, you maybe invest a little less because you've managed to deploy some funds. You want to build up your cash reserves again, but you've secured in that beautiful discount. So perhaps after that, you just go back to regular intervals at that lower rate, but you've already managed to secure those units at a really, really nice discount. It's going to help your portfolio grow over the long term. Psychologically, you feel like you've had a little win because you've got these units cheaper than what you would have had to buy them normally. And you've sort of skipped a few months of investing, because if you were typically going to, commit to that $1,000 a month, $2,000, whatever it is, and then you deploy $5,000, you've essentially just fast forwarded 5 months. You've got it at today's price, not the price in 5 months as well, which may actually be a lot higher. So I think psychologically, this is the best way to look at it. Try and stay away from all the negative talk about the market, because inevitably we will see a dip. We'll see a dip of 10%, 20%, 30%, maybe 40% or 50% in our lifetimes. But just be ready for it. Don't freak out and sell. Don't leave yourself in a position where you'll be forced to sell because you don't have any cash aside or you're not prepared for an emergency. But also don't sit on all your cash and never invest, because you'll miss out on some of the best returns you could have possibly wished for. I highly recommend keeping a level head in these times of volatility, and there's really no way you can fail if you are psychologically ready for investing. Okay, now guys, I know I sort of repeated a few points there, but I really want to hone in on the fact that it's hard to time and beat the market, and it's essentially going to require you to beat the market 2 times, because you need to sell when it's high and you need to buy back in at the right time. So you have to be able to time it twice, and that's not always possible. You might be sitting there waiting for it to go down a little more, down a little more, down a little more, and it never does. It just keeps climbing up. So you miss out on this opportunity to buy back in lower. All right, I hope you got some value from this video. If you did, please like, share and subscribe, share it with a friend, and comment down below if you're going to keep buying as the market dips or it goes up regardless. Guys, I really look forward to seeing you in the next video.